Good afternoon, and welcome to the Texas McCombs Presents. Is that a light at the end of the tunnel or a train coming at us? My name's Jim Nolan. I've been on the McCombs Finance faculty since 1980, teaching small business, entrepreneurship, venture capital, and private equity. Today, I'm pleased to host a conversation with John Hawkinyos, president of TXP, an Austin-based economic analysis and policy strategy firm. There are a lot of economists that could give us data on the national, state, and local economy. But what makes John special is that he is not just researching the data, but personally fills the data as an investor in local real estate, restaurants, and serving on the board of a local bank. He's also an advisor to many state and local government agencies and must think about how this information translates into public and private strategies, which impact the future of key industries and sectors that affect all of us. Welcome, John, and thank you for joining us.
Yeah, I'm glad to be here, Jim. Thanks.
I'm going to start by some open-ended questions for you to address, and then we have some pre-submitted audience questions that I will have you answer.
Okay.
The first one, let's start out with a broad overview of the current economic status. And I like to put things in relative perspective. So, is the U.S. economy in better shape than the rest of the developed world? Is Texas in better shape than the rest of the U.S.? And is Austin surviving the recession better than some of the rest of the state? Can you address some of those issues?
I can. I think that I would characterize where the U.S. is right now as kind of middle of the pack. I mean, you will see data floating around out there about recently released GDP figures that show second quarter was down by about 32%. Well, that's seasonally adjusted at annual rates, blah, blah, blah. An easier way of looking at it is to say, hey, how did second quarter of this year look compared to second quarter of last year? And we're down about 10% based on that. That puts us right in the middle of the pack. A couple of the Asian countries, South Korea, for example, are only down a relatively small amount. By contrast, some of the European countries and Mexico are down by more than 20%. So we're in the middle. Why is that? Well, in part because we have let forward a much greater level of stimulus than most other people have. To give you an example, we spent the equivalent of about 13.2% of our economy, our annual economic output, so far on stimulus. The European Union collectively, by contrast, a little over 4%. So what we've done is we've bought some relief from the impacts of the downturn to date by this extraordinary high level of stimulus in comparison to our peer group. So that's the national picture. Texas, kind of also in the middle of the pack. The industries that have been really hit by the pandemic, at least in this first round, travel and tourism, obviously, energy, obviously, big piece of the equation for sure. And then to some extent, kind of related to this, not so much on industries, but just in terms of communities, the denser the community, the more problems they're having. It's tough to be in San Francisco. It's tough to be in Boston. It's tough to be in New York. Well, by contrast, technology's doing reasonably well. Relatively rural states are doing reasonably well. And states that also have an economic structure that isn't really dependent upon travel, tourism, and energy, doing manufacturing or whatever, they're doing reasonably well. Texas, kind of a mixed bag. Hurting on the energy side, hurting on the airline side, but our cities aren't so dense. We have a strong tech presence. We have a big rural community, kind of in the middle. Austin, final answer to your question, relatively well, partly because of our relatively strong tech presence. We have arguably the most substantial tech presence in the state, relatively speaking, and as a result, compared to most other communities, we're feeling less pain.
Well, Texas has been a beneficiary of people leaving expensive states like California and New York, and we benefited with population growth.
Yep.
Do you expect that to continue, and what sectors that you just discussed do you think are going to generate future growth and jobs?
Oh, I think it's absolutely going to continue. I think that conversation is happening in real time as we're having our conversation right now, where people are saying to themselves, hey, we can get out of Dodge, Dodge being New York City or the Bay Area or Palo Alto or wherever, and we can move somewhere either on a permanent basis or alternatively, and this is beginning to happen, Jim, as you know, in the tech sector, people are saying, can I do my job remotely going forward? And can I get away from the issues that face these highly dense, highly constrained, incredibly expensive areas. And maybe I'm still working for a company based on the West Coast, but maybe I'm living somewhere else. And that somewhere else, in many cases, is Texas. So we are definitely benefiting, I would say, even at an enhanced level from long-running trends, which is folks are wanting to move here, get away from expensive, constrained areas, probably more than ever.
Yeah, and I know you were involved with working to bring the Tesla factory here. You want to talk about that just a little bit?
Sure. Yeah, I was lucky enough to be, as part of my practice, we do a lot of incentive work for people. We develop policy around that. And Travis County actually asked me to help them craft the package and do part of the negotiations, bringing Tesla to the Austin area. And we were fortunate enough to have that happen. That's an exceptionally important event. I mean, it would be important any time. It's a big signal event. But especially right now in this pandemic, Tesla, of course, we think of as this modern economy, advanced manufacturing kind of group, but a tremendous amount of the jobs coming with Tesla to Austin are actually what we call middle skill jobs, meaning that they employ folks who probably don't have a 4-year education. You're going to pay somewhere in the right around $50,000 a year average salary plus pretty good bennies. And so what that means is we've done two things with that here in Austin. One, it's a great shot in the arm as we are, of course, dealing with the consequences of the economic downturn and the pandemic. But we've also addressed a structural problem here, which is that too much of our growth in Austin has been either for people with advanced degrees doing advanced work in technology or in support services around consumer things, again, restaurants, bars, retail, and all that. Now we've created an opportunity for good jobs for people who don't have higher education and they can do something else other than working in the service sector. And so again, really, really big opportunity for Austin.
That's great. Well, let's switch gears a little bit and say over the last 20 years, most of us have lived through the dot-com bust, the Great Recession.
You're way younger than that.
Great Recession of 2008, and now the COVID-19 pandemic. Yeah. So we know the stock market kind of made a V-shaped recovery from March, even though it's gotten pretty volatile the last few days.
Yep.
But the underlying economy doesn't seem to mirror that optimism. So in that context, can you give us the perspective of where we are in this economic cycle? Using a sports analogy, are we in the first quarter, halftime, third quarter, the 2-minute warning? Where are we?
Second quarter is my assessment. And the reason, let me expand on that a little bit. We've seen the first round of effects. I mean, obviously, there are certain sectors of the economy just gotten crushed. Retail, again, we've been talking about this, hospitality, travel and tourism and all that. We haven't seen really the ripple effects of that, in part because we've had such a high level of stimulus, at least up to date. Consumer spending stayed pretty strong. I mean, there was a statistic we kind of ran across while we were having the enhanced unemployment where the federal government was subsidizing unemployment. 3 out of the 4 people receiving it, 75%, actually had more money in their pockets than they made working. And that helped prop up consumer spending for basic things like groceries and rent. And, Home Depot did great because everybody decided to fix up their house and all that. Okay, that's the first round of this. The next round, which we haven't seen yet, are what's going to mean for something you and I care about, Jim, the commercial banking sector. What's it going to mean for commercial real estate? Because what's beginning to happen is we were pretty highly leveraged as a society, and values probably have taken a hit because demand has gone down. And when you're highly leveraged, that means people are looking at each other going, wait a minute, maybe we can't make this work. We haven't seen that play out yet. I say second quarter because it's my assessment. And by the way, I'm no junior epidemiologist. I just, like everybody else, am paying attention. I think by first quarter of next year, we will probably be in a position between either a viable vaccine or therapeutics or some combination thereof to begin to see the public health side of this equation being addressed in a more thorough way than social distancing and wearing masks. And I think when we get to that is when we begin to see some version of whatever the new normal is going to look like coming back into play.
So to kind of visualize this, if it's not a V-shaped recovery in the economy, is it U-shaped? Is it a double dip W? Is it some other?
Well,
symbol that we ought to be looking at in terms, I mean, is this a second quarter of next year, we return to whatever we call normal, or are we looking 3 years out?
Both. I mean, I think that the new term I've heard is a K-shaped recovery, which means some segments of the economy do pretty well and some don't do so well. And I think that rings true to me. I think that it will take a long time for the effects, as it did in the wake of the 2008 recession, on commercial real estate to sort of ripple its way all the way through. And I think there's some fundamental changes coming. I think every company out there that occupies office space is at least going through the exercise right now of asking themselves, what are our needs going forward? And they don't know the answer yet. I think it's not likely that we will all continue to work 100% from home. But I'll give you an interesting statistic. There is, again, because I'm no fun at cocktail parties. I walk around with numbers in my head. There's a group up at Harvard using cell phone data to track people's activity. It's called trackingtherecovery.org. It's worth hitting, by the way. In the Austin area right now, based on cell phone data, we are down 43% in terms of going to work from where we were in January. Is some of that going to come back? Absolutely. Is it all going to come back? Probably not. So we have to see how that all kind of plays out before we can really see what the implications are. My suspicion is that's years, not months.
Well, and you were recently interviewed by the Austin Business Journal, where you made the observation that an economic turnaround depends on people feeling safe to engage in their normal activities.
Yep, absolutely.
Are you seeing any of that returning, and is it different across different geographical areas?
Yeah, I mean, if you were in rural Texas, there's a decent chance you may think this whole thing is a big city problem and it doesn't really affect you anyway. Whereas if you are in a major urban area, either in Texas or somewhere else, I think, it feels in some ways more real. I mean, certainly here in Austin, one of the things we've all noticed is the traffic is nothing compared to what it once was, which at least for me is kind of a minor silver lining. But I think what you really see is, as goes public health, so goes the economy. The countries that have had the least amount of economic damage are also the countries who have done the best job of containing the pandemic, and as a result have enabled people to feel comfortable functioning in the economy. It's no secret we have the largest number of deaths on whatever kind of adjusted basis you want to have. So in theory, we may not have done as well as some other places have, but we've masked that to some degree with our stimulus efforts. And so the answer to your question, Jim, is I'm not seeing it yet. I'm not seeing people feeling that much more comfortable. And I think it's a number of months away still.
So talking about the massive both fiscal and monetary stimulus, are they just masking future problems and just delaying the inevitable? I mean, are the furloughs going to turn into terminations and PPP loans going to turn into bankruptcies? And so what landmines have we not encountered? You already talked about the real estate and that, if people don't need as much space, there's a lot of sublease on the market. Rents fall, then we get into defaulting on mortgages. I mean, when does that all start to show up?
About 10 minutes ago. I mean, I'm laughing because it's not funny, right? I mean, obviously these are real people experiencing real problems, but the issue is stimulus masks the problem. But if stimulus runs out, which as of right now it has, before the problem's resolved, then you've just delayed the inevitable. Guy takes a PPP loan, keeps everybody on staff for 3 or 4 months, still can't function the business, the demand isn't there for whatever reason, the PPP loan runs out. Well, now everybody's gone, right? And the business is done and they can't pay the rent and all that stuff. So if it's not going to have been money that was just spent delaying the inevitable, it means we have to stay the course and keep these companies that rely on the PPP, particularly small businesses, rely on government support, continue to get it until we get to the other side. Can we do that indefinitely? Obviously not. Can we do it for another 6 months? Probably so.
Well, and since most of the people in the audience probably went to University of Texas and have some experience with Austin.
Yep.
I mean, we were billed as the live music capital of the world. Are there going to be any venues left for musicians to play, and without South by Southwest and ACL and
Nope.
things like that, how is that going to change?
Well, no, that's right. I mean, all of those businesses, and sadly, I know this to some degree from firsthand experience, operate on very thin margins anyway. And so if you're on a thin margin and you can't function short of really working with, if you have debt, working with your landlord, getting support from the government, you're just not going to be there. And I'm going to say something that's going to sound vaguely disparaging in another city, and I don't really mean that. But if you take all that out of Austin, we're just Sacramento. And I'm not taking shots at Sacramento, but I did some work out there, and it's kind of like Austin, except, with all the government functions and all that, without all the fun stuff. So anyway, I'm kidding. But no, Jim, you're absolutely right. All of that stuff is in grave danger as we sit here.
So you talked about a K-shaped recovery. Not everything's negative. Obviously, certain sectors have been hit harder than others. So what does your crystal ball tell you in the near and intermediate term of who the kind of winners and losers, what industries and things? Can you give us some examples of some people that have done a good job adjusting to the pandemic and done well?
Well, for sure. I mean, there are obviously people who provide food at home, and whether that food at home comes from you going to the grocery store or you hitting up one of the delivery services and finding a restaurant whose business model doesn't involve selling a high volume of alcohol. Those people have definitely done well. I mean, obviously all the enabling technology around what we're doing right here today, that obviously are folks doing well. One of the things that has been interesting in general, I mean, again, we were kind of kidding about it earlier, certainly the home improvement people. I think actually in some ways, single family residential real estate has done relatively well, in part because people are saying, I am going to be spending more time in my home. And so certain kinds of homes then are more attractive. And I think that's really the point, is that density, there was a move toward density for some period of time. Now that's been blunted to some degree. And now maybe we were saying we don't necessarily all want to live on the 23rd floor in a condo next to 5,000 other people. Certainly seen that in the big cities. I mean, real estate in Connecticut is booming right now. So I think that's all part of the mix. And I think the other thing that's going to happen, we're going to see this on into the future, is we are really discovering what can be done remotely. I tell the anecdote about having a remote doctor's appointment that I was highly skeptical of, and I was stunned at how well it actually worked. I think we've all had that experience in some way, shape, or form. And I think that the ability to interact economically with each other remotely is going to continue to grow, and it's going to present itself in a lot of different businesses in a lot of different ways. What it means is if you are good at what you do, your market may now be a whole lot bigger than it once was. And I think we'll see that evolve over time.
And a few things that surprised me, golf course rounds are way up because people can socially distance and get outside. Right. RV dealers and boat dealers can't keep inventory. People are buying like crazy, but having owned a boat, I know that's the best day of your life is when you buy it, and the second best is when you sell it.
Yep.
So are there going to be a bunch of RVs and boats for sale a year from now?
I would think so. Well, let's try to corner the RV market, Jim. What do you say? Because I think in about 18 months, there are going to be people going, why did I buy this thing? No, that's right. I mean, and that's a great point, is that recreation that can be done, and entertainment that can be done in a socially distant way, that can be done outdoors, is clearly going to be more and more, is going to experience a resurgence. Golf is an example. I think tennis probably will too. And we've learned that, the ball isn't likely to carry the virus. And so I think you'll see people doing things more and more outside. Again, a lot easier to do when you're not living in a big urban city.
So what about some of the industries that are really in trouble? Like I probably wouldn't want to be the CEO of a cruise ship line or an airline right now, or some of the others. I mean, if people are afraid to get on airlines and travel and things, how long can some of those last before it starts to really affecting the industry and flights? And
it already has. I mean, one of the things that was a provision of the CARES Act, which was the big initial stimulus passed back this past spring was that the airlines and the cruise industry all got specific aid, but they were told, look, you can't fire anybody. Okay, we're going to give you guys a bunch of money, but you got to hold steady on the head count. Well, that's all come to an end. And so I believe between them, United Airlines and American Airlines have announced layoffs / furloughs of around collectively 35,000, give or take. That affects us because we have a big, both of those airlines have a big presence here. The cruise ship deal is really interesting because apparently cruise bookings next year are way up. People are like, okay, I was going to take a cruise in 2020. I can't do it, but by God, I'm going, as soon as I can. And people are thinking that's what they'll be able to do. Now, if the virus carries forward, those will all be canceled. But it really speaks to the fact that in these kinds of industries, what you're going to see is a contraction, and you're going to see them going back, for example, in the airline industry, to a model that looks a lot more like before the airlines were deregulated 40 years ago, when airline travel was more of a luxury and it was more expensive, relatively speaking, and it was just a much smaller footprint. I mean, that's logically what's going to happen, especially because now, if I have a client halfway around the world, man, we're pretty comfortable doing this remote thing, and we didn't used to be so.
Okay, good. So I know you also advise a lot of state and local governments and their policies and things. Obviously, they're going to get hit on the revenue side pretty hard.
Oh, yeah.
Property taxes, sales taxes, things. So what happens to them? I mean, Austin, some of the other, Dallas, Houston, already have a pretty high tax bill to pay. And, are they going to increase taxes? Or are they going to issue debt in order to bridge the gap? What's the strategy?
It's all of the above. So we've had again some masking on the sales tax side, which is the most immediate feedback because of the level of enhanced unemployment, and stimulus has kept consumer spending better than we thought it was going to be. Most places will end up fiscal 2020, which for most cities ends at the end of this month, down no more than about 5% from where they were last year, because 6 months of it was pre-pandemic. And then we've had stimulus to help the back 6 months. Next year is probably going to be, for a lot of places, break even down a little. And hopefully, as the economy recovers a little bit on the back end, it'll be better by comparison. Property taxes are okay for this coming year because the impact of all this won't hit values until a year from January, which is, the tax rate is going to be set, and you're going to pay your taxes predicated on values of January 1 of 2020 for the coming year. So there's a lag factor associated with that. Cities are, if there's an emergency declaration in place, which there is, in theory, I can say that, cities can raise their tax rate 8.5%, but most of them won't. And most of them are going to try to live within the caps imposed by the Texas legislature, which is a 3.5% increase. So I would see values dropping, tax rates rising, and cities hoping to break even in the process.
All right, so I'm going to kind of switch gears a little and have you address some of the audience questions.
Sure.
And one of them was the effect on small businesses and entrepreneurship. Small businesses now, even if they can survive, they're going up against now much larger competitors like Amazon and others and Home Depot. They've gotten much larger during this pandemic. How do they compete going forward?
It's tough, and a lot of it depends on the type of business you are in and whatever. I mean, and what's made doubly tough by it is that if you are in a brick and mortar small business, you probably had to personally guarantee your lease. And if you had to personally guarantee your lease and you can't make rent payments, now you've got a double whammy, because now your business is done and you're probably personally bankrupt as well, which makes it just that much tougher to come back. So small business is where you're going to really see a lot of the negative impacts of this. In terms of competing with the big guys, it's going to be what it's always been. It's always been about finding the niches that the big guys can't operate profitably in. And what that typically means in the modern economy, Amazon can literally sell anything to anybody. So there's going to have to be a customization or a service component built into your offering as a way to compete around Amazon, or it's going to have to be something that's perceived, kind of building on that a little bit, that's perceived to be artisanal, that's perceived to be special in some way and unique, that by definition, if it's being sold on Amazon, it's been commodified. So that's a trend that's been going, as you know, Jim, forever. I mean, that's back to the Walmart conversation, 20 odd years ago. It's now just heightened as we're going forward.
So we also had another audience question that said, what does the post-pandemic future look like for nonprofits and social enterprises at a time where their need for services are rising?
Grim. I mean, it's a tough situation there, because most not-for-profits obviously rely on some mix of grants and philanthropy, and in some cases, fee-for-service around governments, and all of the normal sources potentially have been hit. Now, I'll tell you, the one area that may be okay is if the stock market continues to be a little out of sync with what I think of as the underlying economy. If that translates into philanthropy, then there's potentially a little bit of a ray of sunlight there, right? Because a lot of foundations, for example, use the performance of their portfolio to determine the amount of giving. And so in that situation, you could see some things maybe not be so tough. You could also, there's going to be a large chunk of people whose jobs are just basically unaffected by this, or at least whose incomes are unaffected. So I think it's going to be incumbent upon not-for-profits and small groups who provide these kind of essential services to really think about their revenue streams, identify the ones that are at risk, and really make a concerted effort to compete hard from people who aren't, from sources that aren't so much at risk.
Great. Well, I know another big area that we got lots of questions on is the oil and gas and energy sector. So you want to discuss kind of industry considerations, including, are we going to see a lot of consolidation? Are we going to see, lots of bankruptcy? Is that going to actually help renewables?
Yes.
And, if it stays depressed, oil prices stay depressed, where does that put the energy sector? And obviously that affects Houston pretty heavily.
Yeah. So, I mean, I am not an expert on energy per se. I mean, obviously it affects to some degree some of the things we were involved in. But energy fundamentally is about global demand when you get right down to it. It's not much more complicated than that. Global demand is down in part of nothing else because travel and tourism is down. And so people aren't flying as much, et cetera, et cetera, et cetera. So with that comes a depression in prices. I do know that the industry is far more efficient and able to produce profitably at a far lower dollar level in Texas than it could even 10 years ago. And so that is helpful to some degree. And most of the time, I think this happens in the energy sector, it happens in the building trades, is tough times weed out kind of the marginal operators. I mean, we've seen that over and over and over again. You will see bankruptcies. You will see, obviously, consolidations. But what you'll see is people who are strong, solid, capable operators finding a way to navigate through, and the folks who aren't are going to have a tougher time associated with that. So actually, Jim, I wanted to mention this too, because I imagine we're going to get a question on this. One of the things that people are worried about with this massive level of stimulus is inflation. And energy is a big piece of that. Stimulus is inflationary. There's no question about it, especially given the Fed's overt guidance saying we're going to keep interest rates at extraordinarily low levels, and we're going to basically tolerate a little inflation in the economy. But energy prices are going to remain low, and real estate prices, I think, are going to be depressed. And energy and real estate are two of the biggest components of measuring overall inflation. So you will get, to some degree, some increases for things like going to the grocery store. You're going to see some increase in food costs and all that. But in terms of overall inflation, I'm not that worried because those two big elements, I think, are big kind of downward forces on it along the way.
Very good. So talking about some of the social issues that are around right now, what do you think the effects on COVID are going to be on kind of income inequality and issues like that? Or is it going to flatten things out, or is there a middle class in the United States that's still going to emerge out of this? Where are we?
Well, it's going to make it worse, because one of the things that and again, this is really interesting work. Again, I mean, I'm like everybody else. I steal other people's good stuff. So again, the people up on that tracking the recovery thing have discovered that this is particularly hard on people who do jobs that serve rich people's discretionary spending. And so affluent people, again, aren't traveling very much. I mean, this is a theme we've repeated over and over. Discretionary spending for the very affluent is way down. People who serve that, the guy who takes care of your lawn, the guy who serves you at the bar, whatever, people who provide those kinds of services are suffering as a result. What I think you're going to see is, I think this is, again, it's putting more pressure on the income gap along the way. And I think I don't see any mechanism other than, again, the proverbial Tesla's coming that really does anything about that.
So what about, someone asked the question of, does this COVID mean the end of dense big cities? And we know that people are moving out of San Francisco, New York, and others, but Austin has 4 of the top 11 biggest cities in the country. So how do you see that affecting? I mean, I know there was a lot of emphasis on getting dense downtown and walkable and things where we could eliminate the traffic problem. Now that this has happened, what does that say about high-rise apartments and big office towers and real estate issues like that?
So I'm going to be bold and tell you exactly how I think it's going to go. All right. First of all, nobody's going to get financing for any new construction related to this anytime soon. Yes, if your project's in the pipeline and you're past a certain point, it's going to get built, and that's going to be it. So we're going to constrain supply of this kind of stuff pretty soon. People are leaving big cities downtown right now. They're like, look, the value proposition isn't there anymore. It's expensive. I can go to the suburbs, blah, 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 blah. That's going to happen. Prices in downtown, therefore, are going to drop. And somebody's going to look up and go, you know what? That condo used to be $1,000 a square foot, and now it's $600 a square foot, and now it's a good move. And now that's when people will do that. People will take advantage of a buying opportunity, will pop in, repopulate that stuff, and then somewhere 3 to 5 years from now, everybody's going to look up and go, oh my God, we need more stuff. And that's when you'll begin to see financing coming back to begin to build downtown stuff again.
So we know that the 2008 recession, Great Recession, was pretty tough on the financial sector.
Mm-hmm.
I know you and I both serve on a board, and banks seem to be putting a lot of money into loan loss reserves.
Mm-hmm.
So is that something that could trigger another downturn in a secondary recession if the banks start to get?
Yeah, I think it could. And I think what really worries me about this is that the 2008 recession, as you know, was based on kind of the over-securitization of residential real estate. Well, we stopped that. In fact, the dollar volume of securitized residential real estate actually went down from 2008 to today, but the dollar volume of securitized commercial real estate more than doubled. And that's where I think some of the bombs lie. From a banking perspective, and Jim and I serve on together on a sort of a medium-sized community bank, I think the issue is twofold. One, I think that there are issues in the portfolio that are concerned, but I also think, where's demand for loans going to come from? I mean, sure, there are tons of people who want to borrow money. Well, what do you got as collateral? Well, I got this real estate. Well, what's it worth? Well, who knows, right? That was the big thing in the wake of the 2008 recession, was that people couldn't collateralize lending because they couldn't establish what property values were. And at the end of the day, most of the time, collateral is based on some form of real estate. Yeah, sometimes equipment, but really most of the time it's some form of real estate. So I think that's the area of concern. Now, a mitigating factor is, of course, the rise of fintech. And there are going to be all kinds of people out there offering capital in all kinds of ways. God knows how you underwrite that stuff. I really don't. And I don't know. I mean, I admire anybody who can figure it out because, again, I don't know what kind of security you can put around it. So that's what I'm watching. I'm watching kind of the impact on commercial real estate, the roll through from commercial real estate to traditional commercial banking, and then by extension, how do we underwrite lending going forward?
So you've kind of addressed the major industries in Texas, energy, oil and gas, real estate, banking. What about like healthcare? How is COVID going to really impact that industry? You already mentioned telemed and things and how that's been a plus, but what's the downside to healthcare at?
Oh, it's a big challenge. I serve on a board of directors of a hospital, and I won't say which one, but I mean, at the end of the day, hospitals it oftentimes rely on discretionary procedures for a lot of their profit margin. And when you have the kind of public health crisis we've got now, you have two problems. Sometimes discretionary procedures are just forbidden. Even if they're allowed, people are nervous about going to the hospital. I mean, they're just emotionally concerned about it. And so you put all that together, and it's very tough on the hospital side of the equation. I think on the physician side of the equation, I think telemedicine has allowed a number of physicians and other sort of direct ambulatory healthcare practitioners to kind of navigate through a lot of this. But the healthcare sector overall is struggling through this because, again, a lot of the stuff that provided margin to help you, for example, offset your uncompensated care is just not happening at the same level it was prior to the pandemic.
And then the last question I'll ask you is, what about the effects on education? Higher education and things that affect UT, and more importantly, are we going to have football this season?
Well, we're Texans, right? So, I mean, if we don't have football, we might as well just call it a day. I think higher education is facing a real challenge, and the biggest challenge, quite frankly, is one, trying to figure out how to navigate this environment. But more than anything else, it's trying to maintain the value proposition doing things remotely. Because I think what schools all over the country are discovering is that bringing students back to campus has its challenges, right? I mean, we're dealing with people who's at the end of the day won't always do exactly what they're told. And so if that's going to be a problem, you're looking at more of a distance learning environment. If you're looking more of a distance learning environment, it's tough to maintain the value proposition. Because I remember this, and I think you do too, a big part of the value in going to college wasn't just the academic experience, it was everything that went with it. If I'm doing it remotely, I've lost a lot of that. And so I think for universities in many ways are kind of the tip of the spear on this thing. We've got to get to the place where you can begin to safely have that experience, that university experience, which involves being on campus and getting to participate in all the stuff that goes with going to college, other than just listening to Professor Nolan talk about, marketing.
Very good. Well, I want to thank you, John, for your time today, and thanks to all our viewers joining us today. Also, thanks to the Texas Presents staff for their coordination of this event. You will be receiving a recording of this conversation and a follow-up email with a short survey when the session closes. We hope you will join us for our next event on October 14th at noon with Sam Acho, a McCombs alum, UT football star, and NFL football player. He will be sharing how he learned to be his real self in the workplace. I wish everybody a safe and healthy future, and thanks for joining us today.